गुड इवनिंग, वेलकम, नमस्कार। आज का ये इकोनॉमी मार्केट्स और इन्वेस्टमेंट्स के प्रोग्राम में मैं मिक्स ऑफ हिंदी और इंग्लिश, स्लाइड्स आर ऑल इन इंग्लिश। मैं बातचीत में हिंदी और इंग्लिश को मिक्स इट एंड से, बट इन द क्वेश्चन आंसर सेशन में if you ask me a question in Hindi, I'll reply in Hindi. If you ask me a question in English, I'll reply in English. And for the Tamil speakers too, I'm happy to reply in Tamil. Not a problem at all. So do not worry. But the slides are all in English, so you should be able to understand what's there, right? So just 1 minute. So as usual, economy, markets and investments is what we'll be covering. This time, let me start with the markets and then we'll refer to the economy as and when necessary. Jaise zarurat padti hai, we'll do that. So first thing is that the year 22 has been both eventful. As you can see, January May, we had an all green stock market. June, we had an all red stock market. And again in November, we have all green stock market. So what is happening in the market that it is showing such violent change of mood? The answer to that lies in the fact that market is driven by the people who own the share market. And in this slide, if you can see, right, this is the free float market cap. Abhi free float market cap kya hota hai? It is the ownership by non-owners of the businesses. So Azim Premji's holding of Wipro is not here because that is not available for sale. कोई उसको बेच या खरीद नहीं सकता है ना. So 36% of the stock market is owned by the promoters of companies. So balance 64%, right? Of that 64%, 40% is owned by FIIs. Another 15 to 20% is owned by mutual funds. So if you see 55 to 60% ownership of the free shares which are available for sale is with just these two big entities. So if you try to understand unka investment pattern flows, when they put money, when they take out money, you'll get an answer to the volatility of the stock market. So let me proceed now to the next slide, right? So from COVID time, every quarter, this is how the FII first line tells you the FII flows. If it is in green, it means positive flows. If it is red, it means outflows. So as you can see, there is a pattern where sometimes FIs are buying, mutual funds are selling. Sometimes FIs are selling, mutual funds are buying. Sometimes both are buying. But over the last few years, from 2020 to now, there has never been a period when both are selling, as you can see, right? So this we will now try to understand in greater detail, because this is what will give a clue ki aane wale din mein, future, how is the market going to be. So in understanding FII flows, we'll come to MF later. In understanding FII flows, the main factor is that flows kab hote hain, inflows or outflows ke liye advanced countries se paisa emerging market ko aata hai. It comes from advanced countries to emerging market. So it's a function of, in the advanced countries, what is the inflation scenario, what is the interest rate scenario, and what is the liquidity scenario. Once these three are taken into account, if emerging market is attractive, then money comes to emerging market. And within emerging market, if India is attractive, it comes. Naturally, opposite is also true, right? So from that point of view, this gives you, from the COVID period, across various emerging market, how the FII flows have been, right? And you can see there are three buckets that I've put. First bucket is from somewhere around Jan 2020 till September 21. What you see, most of the markets got outflows except for India. Okay, so this is the first period. Second period is from October to June, just a short 9-month period, when most emerging markets had a mixed opinion. They started off with positive, then moved to negative, but India turned suddenly negative for FIIs. But Indonesia became fully positive. Second period, October to June. Third period is from July to now. As you can see, again, now India is back to positive. Indonesia is positive, but less positive, right? And you see Taiwan and Philippines are still negative in the first part of the year. So this pattern, agar now we analyze, start with COVID, because yahan pe COVID is where we started. In COVID, what happened? See, you had a lockdown happening. Because of lockdown, what happened? Demand fell. Because demand fell, prices of gas, coal, Brent crude, or food, or commodity, or metal prices all came down. Now, if these prices come down, it means it's a deflation, not an inflation. So the start of COVID started with the commodity deflation, but inflation was still dominating the headlines of the advanced countries. Why? Because the supply side crisis means in certain key manufactured goods, there was a shortage of supply. So the prices went up. Second is the demand side stimulus. US government gave money to their income tax payers, or at the same time, Fed and ECB were pumping liquidity as well as the ECB. And third is that rates were being cut. So this slide now explains to you, I've taken 1 year after COVID, from Jan 21. Up to that, there was deflation. In Jan 21, the effect of the stimulus, the effect of the supply chain disruption, and the rate cuts and the QE finally made inflation in America grow from, on the left-hand side of the from 1.5% to almost 6%, right? And if you see at the bottom table, you can see that US had cut interest rates over the previous 6 months by almost 1%, over the last 1 year by 1.2%, and 10-year government of US borrowing rate came down below 1% to 0.88. So severe rate cut. At the same time, I have circled in the graph that from the time of COVID, the liquidity, which was $4.5 trillion, if you can see that line, 4 to 4.5, suddenly doubled to $9 trillion. So lot of liquidity, rate cut, and the stimulus all pushed up the inflation even during the COVID phase to about 5 to 6%. So what happened? Not only the Fed, even the G4 countries, which account for 98% of the liquidity in the world, went up from $15 trillion to $30 trillion. So the world was flushed with liquidity, which caused demand to go up and prices to go up. Right? And hence, in that period, if you recollect that table now, the first phase I've taken out here. So that is why, if you see what has happened, India got a lot of flows during the COVID phase, whereas all other countries got outflows except Indonesia. Why was this? Because when oil price falls, which is what happened during the COVID, India, because they import 83% of the oil, right? The FIIs expected these 8 positive factors to happen to Indian economy and Indian stock market. Inflation will ease, so RBI doesn't need to do rate hike. Consumer demand will go up. Trade deficit and fiscal deficit will be under control. Government of India's borrowing costs will be stable, so they can spend more on capital expenditure and give a boost to the economy. Corporate margins would not shrink because they will expand, because their input costs are low. They may not pass it on to the customer, so their profits will go up. The stock market will naturally rise because if EPS is going up, stock markets will go up, so investors' returns will be better. And finally, Indian currency will not weaken. Normally, India currency weakens with the dollar because their interest rates are normally lower than our interest rates, and their inflation is normally lower than our inflation. But in a situation where India's imports are coming down, currency would not weaken, so FIIs will be happy to put money into India. That's why, if you saw, India got such a lot of flows. But in that same period, mutual fund investors, this same graph of the previous table, which is in dollar, I've converted to rupees. So if you can see, every quarter, FIIs put in a lot of dollars into our market, but mutual funds, the red line, sold. Why? Because investors of mutual funds were very worried about the COVID impact on the economy, and they pulled out money from the mutual fund, and hence mutual fund had to sell. So the net inflow into the market is FII inflows minus mutual fund outflows is still positive. That's why Indian market in that period went up. And then from Q2, mutual fund also turned positive because investors realized 2 things. One, Indian economy was recovering rapidly from COVID. A V-shaped recovery was coming. Second, they all felt the effect of missing out because in the previous 4 quarters, when they were selling, market was going up because of FII flows. So they suddenly felt that by redemption from the market, they lost out on the return. So they came back with double speed. So from April, May, June of 2021, they started coming back. So there was a double impact of buying. But as you can see already, FIs had already started slowing down their flows. Why? Because a change was happening. From October 21, the Russia-Ukraine crisis was starting to happen. And so energy, food, metals, right? There was a further inflation. So if you see the right-hand side, the oil prices, which fell during COVID, now started rising. The commodity and food prices, which fell during COVID, now started rising. So this supply side inflation impact means that when you go to the first graph on the left of your screen, you can see that inflation went from 5.5% to 6% to all the way up to 8.5% to 9%. So US economy saw a massive inflation, right, from 1.5% in Jan 21 to almost 9% by May. So this panic, however, this inflation spike in October was not acted on by the Fed because they said this looks like temporary inflation. But the market players felt that that was wrong, and hence the FIS panicked, started pulling out money. So then when you see, right, in October, November, December onwards, India completely negative, right? $5 billion, then $14 billion, then almost $14 billion pulled out money. But if you see, they put money in Indonesia. Why? Because Indonesia is an exporter of commodity. So India started getting the impact. So you can get the answer in what I'm saying. Now the oil price rise, right? Because India imports 83% of the oil, the opposite impact came and haunted the FIIs. And that's why they pulled out money from the Indian market. Again, going back, this same number, I have written here that whatever is in red, they got it wrong. Only the green corporate margin shrinkage, they got it right. Why they got it wrong, how they got it wrong, we'll analyze. But this action by the FIIs of pulling out money during oil price rise was essentially due to this factor. And how they got it wrong, you can see first. In India, inflation, though it was near about the American inflation is black line, India inflation is blue line. You can see that they are near each other. But US went from 1.5 to 9. India went from 6 to 7. So our inflation was broadly around what we are experiencing. Why was this? When oil prices went up, why the inflation didn't go up? Because the inflation that went up was the WPI inflation. It did not come to the CPI, which is the lower line. Why did not come? First, corporates absorbed the hit. That's why corporate margins got affected, as I told you. In retail customer did not get the hit. Number two, government increased excise duty on the petrol and diesel, so that what happens that they're decreasing the excise duty, right? Meant that the government took the hit by a lower income and the customer did not feel the pain. Now that lower income of government was compensated by putting a windfall tax on the oil refining companies, which were enjoying the rise in the price of the oil. So government smartly managed its level. Oil marketing companies took the hit because they got super profits. Some of it went as a super tax. The third aspect on food inflation is that the government banned the export of wheat, rice, sugar. Yes? Sorry. Shweta, can you mute others?
Yes.
Yeah. So what happened was the government banned the export of wheat and rice and sugar and all. So what happened is that because of which international prices of wheat went up, but Indian price of wheat did not go up so much. The third aspect on oil is that we were not facing the full brunt of the oil price rise because we took a stand against the US sanctions on Russia and we went and bought oil from Russia. So India saved 35,000 crores by buying oil from Russia cheaper because Russia gave us a 25 to 30% discount on international oil prices. So that also meant that oil price impact on India was far, far less. So for all of these reasons, Indian inflation did not turn out to be as bad as FIIs expected it. Next, on the currency, if you recollect in that those 8 points, there is also the currency impact. But if you see, Indian currency only weakened in this line. If you see the yellow line is the dollar XY. DXY means dollar against others. And the blue line is dollar, rupee, dollar. If you can see, both are going very together, which means what? Indian rupee only depreciated to the extent that dollar appreciated. In fact, against the euro and the pound, our currency strengthened. So Indian currency did not weaken much more than the dollar strengthening because of the fact that RBI managed this very well. How did they manage? First of all, we saved because we bought 35,000 crores worth of savings from importing from Russia. To that extent, we needed less dollars. Second, we didn't pay for Russia in dollars. We paid in ruble or we paid through barter because we export something to Russia. We set it off. So we got savings in foreign exchange from that. Second is that RBI used the foreign exchange reserves. The blue line, which is the reserves, is that we had $640 billion of reserves in August 21. We used $100 billion from 640 to 530, $110 billion to fight the weakening of the rupee. So we did a very good job of defending the rupee. The third aspect is RBI also used interest rate hike to actually prevent the rupee from weakening, because it's the difference in interest rates between America and India which decides how much rupee will weaken. If US raises interest rates and India does not, then that gap gets made up by currency. But because India also raised the rates, we kept the gap the same and did not allow the currency to weaken. This again, the FIS got wrong. They thought rupee, instead of going to 82.683, would actually go to 87, 88, but it did not happen, right? So now, going back to the international scenario, by now, the Fed realized that this problem is not going away. It is not a temporary problem. Now they decided to address the inflation issue, and they started aggressive hiking of interest rates and announced QT. So if you see, the US, the inflation had touched 9%, they started panicking, and they are hoping by aggressive interest rate hike to bring down this inflation to 3% by December 2023. So in the battle between inflation and growth, now for the Fed and the ECB, inflation was a priority. They said to hell with growth. So from that point of view, in their economy, hyperinflation targeting means you have to cool the demand down through interest rate hikes. Why do I say that? Because in US CPI, if you see the breakup, the blue block, 42.4% is housing. So housing is a demand because US consumers got very cheap rates. I'll just show you that slide. At about 2.5%, they got rates for 30-year fixed rate mortgage loans. So there's a huge housing boom, which pushed up demand side inflation. Now the rate hikes, which the Fed has done, which is from almost 0.5% level right up to 4%, the short-term rates went up. Same with the ECB. So as a result of which, the long-term rates, which if you remember in the table below, I'm showing 3.77 was 0.88. So short-term rates went up by 3.5%. Long-term rates also went up by 3%. So US government's borrowing costs also went up because of this. And hence, you saw that the difference that is shown here, that housing loan rates went from 2.5% levels to 6% levels. So naturally, this has started to kill the demand for housing and hence a whole lot of commodities and others. So commodity deflation started setting in America and others. So you can see now here that this is the commodity price chart. It went up in June to September, October, it peaked. And from then on, if you see, because of the announcement of rate hikes and all of that, the commodity market started coming down. So whether it's overall commodities or metals or food or oil, all of them have started coming down. So naturally, at the same time, because COVID was largely tackled by the world, except China, where it is showing up its head again, the supply chain disruption to inflation also started coming down. So this expected to ease inflation, and hence the Fed, whether they will succeed in reaching the 3% which I have circled is different, but definitely the inflation has to start responding to the Fed's rate hikes. And hence, now you see, in a decreasing commodity inflation, back again, money came to India and the money to Indonesia started following, right? So the same story again playing itself, because India imports 83%. All these positives were in front of FIIs. Plus, what happened was FIIs, can you see here in this period, they had sold and Indonesia had bought. And then if you see down, when they sold in that period before Fed started hiking, the Indian mutual fund investors were actually buying. So the negative reaction of the market started from Q1, January, February, March, because in the previous quarter, mutual fund inflows were actually more than FII outflows. So market got net 7,430 crores positive buying, right? So on this angle, now when you summarize this whole period, you can see that those three periods that I've marked are actually commodity deflation, commodity inflation, back to commodity deflation, and hence now when you see in commodity deflation, India got money, in commodity deflation, India lost money, and back again when it's commodity deflation, we're again getting money, right? So as a result, now when you see and you look at the pattern, right, the periods up to January 1, if you take on the table. So if you see Q2, Q1, JFM, you are seeing that. So there was strong positive buying in October, November, December of 21, right? So as of January 1, 22, that net buying showed a huge positive stock market. Now, when you state from January, February, March, and April, May, June, because the FII outflow was so strong, 1,10,000 crores, but mutual funds were able to buy most of it, but still there was 40,000 crores, 35 to 40,000 crores negative flow. The market bottom, can you see, turned negative. So as a result, now, when you now look at it from that perspective, right, this gives you a good summary, right? That is, FII flows have now started bouncing back into emerging markets, and they also realize that they got it wrong. Hence, they are re-entering the Indian market with double speed. So in this period, about 1 lakh crores of buying in the stock market has led to the market being on a bullish undertone as of November 18th, right? So I hope with this you understood that the key factor for India from an FII perspective is commodity, especially oil prices. And that's the way they take an inflow or an outflow decision, right? Now, understanding MF flows. MF flows was simple, right? When COVID was seeing Indian economy was looking like a downturn, they pulled out money. The moment the V-shaped recovery started and Indian economics started getting and better, their confidence in giving money to the mutual fund industry means mutual fund turned net buyers. So simple thing, MF outflow trend is strongly correlated to domestic economic outflow, right? So from a short term now, this market will be driven by the flows perspective. Hence, here you're seeing that we have in a commodity deflation scenario. Even the commodity inflation happens, FIS took out 2,55,000 crores. But from July to now, when the commodity deflation has again started, 78,000 crores has come back. Still 1,80,000 crores of FII flows are yet to come back to our country. On top of it, if you see, mutual funds continues to be positive. So how much of that mutual fund money will now come back is a question, but whatever it is going to add to the FII flows because Indian economy outlook is good, and hence you see month on month SIP book is going up, just touched 13,000 crores. So mutual fund domestic support and the FII inflow coming back will take the market to new highs over a period of time, right? So now when the FIS look at it and said, look at the Indian markets from what has happened to the money they put, if you see year to date, that is from January 1 to now, India is that market we have lost the least amount of money. In dollar terms, India has lost them 2% negative. That is 100 rupees has become 98 rupees. But in all other markets, their losses are in high double digits. So from an FII perspective, his investment for in this year's performance, India is the best from terms of least loss. Otherwise, they've lost money in all the markets. But if you take from post-COVID phase, so the left-hand side, you see March 2020 was the bottom of the market. From that time to now, the yellow line is India. So what can you see there? You can see there that the yellow line is the highest line, which means that for an FII who stayed invested for 2 years, from January 20 to November 22 or January 23, maybe 3 years, the best return has come from his investment in India, even better than the return he got from America, which is the pink line just below India. So MSCI India continues to stand out, and India, that's why, is the darling of the FIIs, because they have made the most money from their investment in India. In fact, if you see as of last week, also the various index, American index and the various emerging market indices, MSCI India is fully in green, and in 3 years, it has given them 57% return, whereas America has given them only 30% return. So if you see any time period, our returns are strong. In last 6 months also, they have made 11% return from the Indian stock market, right? So obviously, from an FII perspective, his decision to have invested in India is very happy. And when he pulled out the money, he realized that he has missed out on returns, because he could have made even more money if he had not pulled out his money, right? So the other aspect is, from an FII perspective, is that the volatility of the market, utar chadav as they call it, right? There also आप देखेंगे, so you are seeing that the red line, India's volatility, is much less than the global volatility. So overall, India has also given more peace of mind to an FII investor. Not only that, the point-to-point return has been better, the journey to that return also has been smoother and less ups and downs than the global market, right? So obviously, from that point of view, now looking forward, the emerging markets attractiveness for the FIIs and then India's attractiveness within emerging market, the point is, will this commodity deflation continue? Now, the point is, all of you are reading in the newspapers that advanced economies are heading towards a recession. And the only question is, a hard recession or a soft recession, right? Now, this is where the IMF is. The IMF so far is predicting a soft recession, because you can see that in 2021, the world grew by 6% in calendar year. 22, that is expected to be down to 3.2, and they're expecting it to come down to 2.7 by next year. So the left-hand side. Now, in the middle of that, the same thing for advanced countries. You can see from 5.2, they're going to come down by half to 2.4, and next year by half of that to 1.1. So very sharp fall in advanced countries growth. But in emerging market, yes, last year was 6.6, this year is half of 3.7, but it's going to be flat for next year. So overall, emerging market economies are going to be in a better situation than advanced economy. So you should expect this continued flow of FII money from advanced country into FII, into emerging markets, right? And if you then look at the recession probability, now IMF doesn't take probability now, IMF computes the data, but market participants conduct research, right? So Bloomberg has conducted this research, and when they have taken a poll and ask people, what do you think is the probability of recession? As you can see in this slide, Germany, Italy, Eurozone, UK, France, US are all at 50% plus probability of recession. And I have circled India there, we are close to zero. Why that is, we'll come to now. But before that, the support for a recession in the advanced economies is coming from multiple factors. What are they? So, dekhenge, so you will see that US 10-year rate, as I told you, it's gone to 3.77. Germany is about 2%. But the point here I wanted to tell you is that 1 month return has turned negative, which means what? This is what they call as the inverted yield curve, right? Which means what? While Fed is hiking short-term rates, the long-term rates over the last 1 month has fallen down. So the yield curve is getting inverted. So short-term rates are going up, long-term rates are coming down. Why that happens? It happens when bond market expects a recession. So they say nobody is there to borrow 10-year money because the economy is going to be down. So that's what this slide is telling you, that whenever we have seen last 7 recessions have been correctly predicted by inverted yield curves. So this 8th time also, they're expecting that this inverted yield curve is correctly predicting a recession. The second aspect to this is freight rates falling. That is Baltic Dry Index, which is the booking of shipping. It's come down 30% in the last 1 month. So the last 1 month, the market is saying that nobody is booking their ships. They're not sure whether there will be export orders for them to export. So that demand supply for shipping is also showing a decline. The third aspect is that a dollar index, that is the green line, which has, since the rate hike started, the dollar has started appreciating, right, versus other currencies. But at the end, can you see the dollar is now reversed? It has started falling. So that again is an indication that in a coming recession, the dollar will weaken because American economy will weaken. And at the same time, the euro, the red line, which was weakening against the dollar, has now appreciated against the dollar, which shows the weakening of the dollar relative to the euro. So again, a predictor of recession. The third one, right, and the same thing is shown in this graph, the previous graph and this graph are roughly same. The third thing is gold prices, for example. Gold, typically, normally people say that when inflation goes up, gold will go up. But this time it has been the opposite. Why? Because when the inflation went up, the US economy, right, the Fed hiked interest rates. So gold, what happens is that gold is also a safe haven for countries' money. So India has $600 billion of forex reserves. China has $3 trillion of forex reserves. Not all of them are kept in US dollar. Some of that is kept in gold as a safety hedge. So in a period of rising interest rates in the US, people, Chinese government and Norwegian government, all those surplus countries, liquidate the gold and put it in America. Why? Because it is safe. America is not considered to ever default. Second, they are getting 4% return from their money. And gold is not giving any interest coupon, right? So when dollar rises, they put money into dollar while liquidating some of their gold. But when the dollar is falling, then they're worried about the losing the interest rate. Then they start shifting to gold. So that gold small spike at the end in the graph, which if you see here, in 1 month, gold prices have gone up 6.5%. That means what? That weakening dollar is getting factored into gold prices. Again, an indicator of recession in the US, right? So similarly, crude. In the case of crude, what happened? The crude has fallen. But if you see at the small strike up, now why is that going up? As many of you may have read, OPEC started cutting supply when they saw this deflation happening. They wanted to keep the oil prices from falling too much. So they cut the supply, and that's why oil price went up slightly. But if you see this graph, and that will tell you that roughly the world uses 100 million barrels per day as oil. And non-OPEC countries supply 70% of that. And non-OPEC countries sell all the oil they produce. They don't try to control the supply. It's only the OPEC which decides not to supply as much as the world wants to keep the price high. So today, of a $97 million 2021, that is, they supplied 26, and so they left a shortfall of 1.7 so that oil price doesn't drop, right? But can they do this forever? No, because when demand drops by 10%, and you go to the beginning of this table, 2020, world oil demand came down to 91 million barrels. It is a 10% drop in world demand. At that time, they could not drop their production below 25. So there was a net surplus of 2.7, leading to oil price crashing below $40. So similarly, the situation now, they are right now able to cut supply and protect it because they know there's a core demand in the winter from heating. Every US and European country during winter, their houses are heated. So the demand for energy during the time shoots up. So they know that they are at a weak point and they can't stop buying oil just because the price goes up. So they cut supply and holding it. But once you come to February and March, right, when the winter eases off and when you come to the beginning of the summer, the spring, then oil demand from heating will come down. Then you will see that as a recession is coming on, oil will come down because people travel less in a recession and industries use less in a recession. And then when it heads back towards 93, 94, 91, again, oil price will have to crack. And that's why I'm hessing on this, because as I said a few minutes before, oil prices are what decides FII flows into India. So this in turn means that you have to wait till February, March for the next drop in oil to occur once this happens. In the meantime, you would have also heard about the US price cap on Russian oil, which kicks in from the 1st of the month, December. What does it say? That nobody can buy oil from Russia above $60, $65. Now, that one, today US is a divided house, but if everybody agree, not US, Europe is a divided house, not all are agreeing to the US, but if that really strictly gets implemented, then oil prices could fall even before in the sense of that. But that is the scenario we have to wait and watch. But I do expect by February, March, as the interest rate hikes come off and the recession comes on and summer comes on, oil price should definitely crash a little bit. And that's positive for flows from India, right? So apart from the oil related attractiveness, right, for India, within emerging market, our economy is also one of the economies which is decoupled from the rest of the world. What do I mean by decoupled? It means that when the world is going from 6 to 2.7 and emerging economies are going from 6 to 3.7, already they are doing better. But India within that is expected to go to 6.1 only drop next year. So 6.1 compares to 4.4 of China. In fact, India is going to be the fastest growing nation in the world in the year 2023. So from that point of view, if you then look at this slide, you will realize that all world growth rates are getting downgraded very sharply. India's is more or less stable with a small downgrade. So that way, if you see Indian economic outlook is looking positive, you have both manufacturing and services PMI on a positive basis, and you have most of the economic indicators on a V-shaped recovery path, except vehicle registration, which is more because of lack of availability of vehicles because shortage of semiconductors than demand. Demand is very strong for vehicles, right? And the activity tracking index is indicating that for the next few months, you will see a continued rise in the GDP for the next few months, right? And while India is not immune to a slowdown in the US, we are, of all the countries, one of those least affected by a world slowdown. In fact, if you see the exports chart, India's exports have grown strongly over the last 10 years from 1% of the world to 1.9%. But at 1.9, we are too small. We are as a share of the world exports. So 98% of the world exports are supplied by other countries who are much more likely to get impacted by a recession, and India will be very limited in its impact because of a small share of exports. Hence, India's recession probability is close to zero. That is what I put back this slide to show you. So Indian economy is effectively decoupled, and Indian situation is also from a government situation in a very good health. So if you see here, India today is the fifth largest economy in the world. But if you see the debt that we have, our debt is the lowest of the top 12 economies of the world at $0.62 trillion only, right? Whereas US has $30 trillion of external debt. At the same time, if you divide that external debt by the GDP, we are only at 17.6% of GDP as a percentage of external debt, which is the second best in the world after China. So fiscal situation of government is relatively very good. In fact, if you see in the current year, right, the income of the government. So the last two columns, if you see, this FY23 budget estimate for 6 months, what they expected the growth of the various income and what actually happened. And everything that is written in green has come out much better than expected, except excise duty. Why? Because government cut excise duty on petrol in order to save the consumer. Otherwise, you see corporate income tax, personal income tax, both are 25% or 20% plus above the expected growth rate, which is only 13%. And GST collections at 33% are more than double the growth rate of the expected at 15%. So income of government is very good. You have seen the GST chart showing the same thing. At the same time, this additional income, where did they spend it, is also important, because if you see capital expenditure, they expected to spend 25% increase in capital expenditure for the half year. They've actually increased capital by 50%. So the quality of the expenditure is very good, because of which they see the NREGA expenditure, which is consumption expenditure, which goes waste, is coming down, and CapEx, which builds roads, airports, ports, all of that infrastructure is going up. Hence, government's fiscal deficit, even with this expenditure, because of the strong income, only 37% of the fiscal deficit they have used in the first half. Whereas in the previous years, 80 to 90%, they would spend all their money in the first half, and second half, they would tighten their belt and tell every ministry not to spend. This year, they've only spent 37%. So in the second 6 months, they have the ability to increase their expenditure or stick to it, or maybe improve the fiscal deficit. The budget will let us know what they did. But government situation is in a very good situation. Hence, The other aspect for India is the inflation. If you see RBI in its report, when they talked about the interest rate policy, they said that they're expecting the next year, April, May, June, I have circled that, inflation to come below 5%, which means that there is no chance of a rate hike at that time by RBI. It has to be above 6 for a rate hike. And overall, that's a situation which should be positive for the Indian stock market and economy. So turning our head to valuations now, if you now look at the situation, first thing I want to highlight is looking at valuation from an FII perspective. You see FIIs from 2012, every year except 2018, every calendar year, they have pumped money into the Indian market, right? So naturally, this for them, from an India perspective, from 2006, that's why we have been consistently at 40% of ownership by FIIs of the Indian stock market. In fact, September 12 onwards, this 40 went up to 45 and was 45 for a long time. Then during the downturn in 18, it came down a bit. Again, during COVID times, post-COVID, it went up. Recent selling that was there during that October to June brought it down to just below 40. But average, they've held 40% of the free float of Indian market. That means that because they are consistently buying India's valuation compared to the world market or compared to the emerging market is always at a premium. Why is this? Because of India's strong growth situation, for them, India is a stock in their portfolio, right? We are a growth stock. Whereas there are other countries which are value stocks. So India's position as a growth stock in an FIS portfolio means that they have been consistently for the last 16 years willing to pay a premium to invest in India. That's why the premium is there. And if you look within emerging market, this slide here was overall emerging market. If you take individual emerging market, the valuation of every other emerging market has been coming down, but India's PE ratio has been going up, right? From a FIS perspective. The reason for all this is that not only our growth prospects, the fact is that within the emerging market index, which is what ETFs and index funds investing in India use to deploy the money, India's share of the emerging market index has gone up from 6.7% 10 years ago to 15.3% today, more than double, right? So of every 100 rupees that is invested in an emerging market ETF, 15% has to come to India. So that consistent allocation to Indian stock market has also taken the valuation up. And hence, if you then see that India's profits have also been growing. The left-hand side is a logarithmic chart which tries to smoothen the curve and shows that it follows the trend line. But if you see the right-hand side and take corporate profits as a share of GDP, has seen a V-shaped recovery, which means if GDP is growing by 6 to 7%, profits have been growing by 15 to 20%, which is what this slide tells you, that overall India's corporate, not only the stock market, companies, overall India's corporate profits have doubled from 5 lakh crores to 10 lakh crores, and hence a 20% CAGR in profits is what the market is expecting over the 2020 when it came down because of COVID to 2024. In this period, Indian profits are expected to grow at about 20%. That is what that premium is reflecting, because no other emerging country or any country is going to grow at this rate. Hence, now when you look at valuations from our own historic valuation, you can see that the red line in the middle, solid red line in the middle, is the long-term PE ratio of India. And today the market, the dark blue line, is trading at the long-term PE. So India is neither overvalued nor undervalued if you go by our own history. Yes, in periods in time, the markets have gone up to 23 PE and 25 PE. That's when they would be overvalued and followed a correction. We have a long way to grow from the 18.5 PE to the 23 PE of the previous peak, or the 25 PE of the even previous peak, before we can consider our market to be overvalued. So I would say that India is a reasonably valued market in the context of its own history, right? Now, if you go and look at it, the fact that this is all the short-term outlook for the next 1 year, 2 years. But looking at a longer term story for India, right, I will take a few minutes to explain to you that medium term outlook of India is important for FIIs and MF flows. Why? Because in the medium term, liquidity availability is assured because there's $30 trillion of liquidity floating in the world. And since the last 2006 crisis, they have not at all brought down the liquidity. So out of this $30 trillion of liquidity, which is what has been coming into the Indian markets from 2006, 600 billion is the total FI exposure in India. So 600 billion divided by 30 trillion is 2%. So India gets only 2% share of the world flows in liquidity terms, right? Why I'm stressing on this is liquidity is not going to be a shortage. Second thing in this slide, if you see on the left-hand side of the pie chart, sovereign wealth fund, SWF, is 16%, pension fund is 8%, and mutual fund and hedge fund, 68%, contains hedge funds, which are hot money. It contains ETFs, which is volatile money, but it also contains active mutual funds, which are long-term. So this long-term portion of the market, it medium-term outlook it takes, it is not very volatile from a short-term perspective, number one. Number two, how much a country gets this long-term money depends on the country's share of the global GDP. So India's share of global GDP has been rising, and that's why if you see sovereign wealth fund has gone from 12% of total FII flows to 16%. So medium-term growth outlook is very critical to make sure we get this long-term sovereign wealth fund, pension fund, and active mutual fund money. So from that perspective, the economy's long-term growth drivers are essentially coming from a comparison with China. So India is way below China today in urbanization, way below in passenger car sales, way below. But in the internet usage, India has caught up with the Chinese. They are broadly there. In terms of energy, renewable energy share also, India is catching up with China. But the strong investment cycle for India is driven by a China plus one strategy. What is China plus one? China has seen in the manufacturing explosion that took place where China became the capital manufacturing of the world. Their per capita income, can you see, went from $2,000 to $12,000. The strong growth which came with the price because they saw that labor was growing very fast, population. They put one family, one child, and hence red line, China's population is decreasing, whereas black line, India's population, working age is increasing, so much so that India is going to add 22% of the world's working age population in the decade. And if you take over the next 5 years, there's no country which is competing in terms of supply of labor with India. India is on the left, China is on the right. And if you see the wages, because China's per capita income has gone past $12,000, their average cost per wage worker, right, is $9,766 bottom. India's is at $3,819, which means India's labor is 60% cheaper than Chinese labor. And we're among the cheapest manufacturing labor in the world. We are at the right extreme. And if you see, Singapore is on the left extreme. And India's productivity is also improving. Yes, we are at 4.8 productivity in dollar terms. We are below China, which is well past 8. But if you see over the last 2 decades, we have grown strongly in productivity. And so this growth in productivity, if it increases, will get us even more value. So American CFOs surveyed have picked India as one of those countries they will move their manufacturing to. Chinese CFOs also have picked India, though much lower in percentage, as for relocation of their factories. And hence, in order to get these business moving out of China to India, which is what is China plus one, government is focusing on building infrastructure because roads, railways, ports, inland waterways, airports, these are critical if foreign manufacturers are to use India. Hence, the government has unveiled this plan of 100 lakh crore of expenditure in that 5-year period across energy, urban roads and railways. And infrastructure spend is expected to go up by 40% from 5% of our GDP to 7% of our GDP. And to make that very, very convenient, they have reduced tax rates for new manufacturing companies which come from foreigners, essentially from 30% to 15%, which is among the cheapest in the world comparable to Singapore, right? And hence the PLI scheme, where the government is giving 5% cash back for 5 years to specific labor-oriented China-based manufacturing industries, which are listed here, means that about 2 lakh crores of investment will occur in India to build these factories and these plants, right? And hence give a boost to our capex cycle. After the plants come up, they will help us in our export cycle, right? So Apple, Samsung, all these companies have already announced their plans and started manufacturing. And FDI, foreign direct investment, which comes into these factories, is also showing a year-on-year rise, right? And third is the private capex story, which because capacity utilization has now started rising after COVID to a level of 75%, which is above our long-term average. And if you see when it hits around 80%, real fixed capex really shoots up. It went up by 14% during the time when our capex was 80. We are fast approaching that 80. And hence, though corporate capex in India hasn't happened for the last 10 years, hardly any capex in the coming year, because the profitability of Indian companies is double, they're sitting on a lot of cash. Second, their own business is getting them 10 to 11% profit over and above the cost of capital. So their business is very profitable today. And the third is that in addition to the private sector, you think housing boom is also continuing because affordability to buy a house is the best in 25 years. And you can see the impact in new property sales and in new launches. Both have gone through a V-shaped recovery. So all of this put together is going to give a big boost to the capex cycle. And capex as a percentage of GDP is expected to grow from 27% to 36% of GDP by 2027. And total manufacturing output is expected to go from 400 billion to 1,200 billion, 3 times by 2030, or even 1.6 trillion, which is 4 times by 2030 if everything falls in place. So India's manufacturing as a share of GDP is slated to grow from 15% to 20%, right? Now, along with the rise in capex, you will see employment generation and wages increasing, and hence per capita income rising, along with it, discretionary expenditure will rise. Many economies have experienced a strong inflection point when they hit 2000, after which for the next 2 to 3 decades, their growth is phenomenal, both in per capita growth and discretionary consumption. Example on the left is China, which has gone from 2000 to 5000, right? And you can see here below that in discretionary consumption, China's car penetration went from 16 per thousand to 115 per thousand, whereas India is today where China was there then. Similarly, the story with South Korea, where since they crossed 2000, over the next 2 3 decades, they've gone to $35,000, and your car and your motor vehicle penetration has also gone up very sharply. In India, we have to be a bit cautious. We cannot expect our $2,300 current per capita to shoot up to 12,000, 20,000 and all, but reasonable by the end of the decade, a doubling of this to 4,700, 5,000 itself will help our consumption grow. Why? Because what happens is that this composition of the population changes in terms of income. So in 2010, the first column, when we were at $1,000 per capita, and you see the 5 splits, right? Elite, affluent, aspirers, next billion, strugglers. You can give another name to it by saying strugglers are poor, next billion is the lower middle class, aspirer is the higher middle class, affluent is the rich, and elite is the super rich. What I'd like to point to you is that when our per capita income doubled, the number of people at the bottom of the pyramid, which is 33% of the people who are poor, has come down to 22%. Where did they go? They went into the lower middle class, but in the lower middle class also, equal 11% of the people went up into the upper middle class, the rich and the super rich. So if you see, that proportion has gone from 15 to 21, 5 to 9, and 1 to 3. Similarly, now when we are now poised to double from 2,300 to 4,700, you expect that these poor will come down from 22% to 11%. The lower middle class will also come down from 45% to 40%. So 11% drop here, 5%, that 16% will get shifted to the upper income range of the population. So that upper 3 bucket will now go from 33% to half of our population, which means in actual rupee dollar terms, if you see, right, from the 2021 household distribution to 2031, we think that the number of households earning $35,000 per year is going to go up 5 times, from 5.6 million households to 25 million households. So all this additional income in the hands of the population means that discretionary consumption is slated to go up sharply. Why? Because if you take a poor person, the leftmost column, right? You see 50%, 47% of that person's income is spent on the first line on the right, that is food, beverages, and tobacco. Whereas as the person goes up into the next income level, next income into lower middle to upper to rich to super rich, his consumption of the food, beverage, and tobacco as a percentage of his income sharply drops, and that gets shifted into clothing, housing, transportation, cars, health, education, leisure, these kind of discretionary consumption. So this in this slide, it captures it as a neat number and tells you that non-retail consumption is going to go up from 74% of our GDP to 79% of our increased GDP. So this huge jump means that India's consumption, already we are growing at the fastest in a 5-year growth rate. We are at about 9% year-on-year growth rate of consumption, but we are still in the middle of 58% of GDP as the proportion of consumption in our GDP. But you can see that the US and the Philippines and the Vietnam are all at higher, and we will strive to approach those periods. Hence, this drive towards that will be supported by our 370 million middle class, which is the largest in the world. So large number of people buying goods means that overall Indians' consumption has got a multiple drivers driving it and boosting it up, as seen in this graph. And supporting this will be the banking sector, which today is in a very sweet spot because in non-performing loans, NPLs have been coming down. Their debt, corporates have been, because their profits have been reaping the loans, the debt to GDP is also down from 62 to 48. And India's credit to private sector, right, is huge scope to grow because we are at 51% of our GDP as the loans to private sector by the banks, and China and Thailand are at 100% plus. So from that point of view, the rate hikes are also benefiting the banks because they have increased the deposit rates only by 30 to 35 basis points, but they have increased the lending rates by around 100 basis points, and hence their net interest margins have shot up. Right, so banks are in a very profitable stage. But at the same time, credit growth is now picking up, showing a U-shaped recovery, and hence India's credit to GDP from its current level of 57% of GDP will grow at 17% per annum to hit 100% of GDP by the year 2032. So bank credit is important because retail, that is where you take as loans against FD or credit cards for education, vehicle, all the discretionary consumption items is going to grow at 15% per annum over the next 5 years, means that along with your consumption story, you're going to see the banking lending story also grow. So the three key components, manufacturing, consumption, and services, are expected to grow for the next 15 years at a 12% growth rate. Hence, for FIIs, long-term like sovereign wealth funds and pension funds, India is an excellent market to stay invested in or put even more investments in. So from a business cycle, we are now coming out of the bottom of the cycle, or in the early stage. India is here. We're going to go through an expansion phase and a late cycle phase. Before 15 to 20 years from now, you might see some decline in the story, right? So by the end of the decade of the global growth, 20%, 1/5 of global growth is set to come from India. So as a result, right, India is slated to grow from the current 5th rank in terms of size of GDP to the 3rd rank, overtaking Germany and Japan also in the journey, right? So this give you confidence that FII long-term money will continue to stay invested and grow by the year, right? Now, that's what FIS flows. What about mutual fund flows? Right? Understanding mutual fund flows in the medium term, while the economic growth will give a generally good story, an additional factor for mutual fund flows to come into India is this moderate inflation, this drop in commodity prices. And with that, when our per capita income increases, not only will discretionary consumption increase in comparison to FMCG or staples, you will also see that the savings rate grows much faster because as people get richer, they can't spend that much amount of money proportionately. So if you see from the time that India started at $1,000 in 2012 to the $2,000 of now, when the per capita income doubled, you see that your bank deposit rate has tripled from 60 to 170. So similarly, when we now go from $2,300 to $5,000 by 2032, you will see that the doubling of income will lead to maybe tripling or even better of the overall financial assets in the country. And in a moderate inflation period, this is very important because in the last few years, as India's inflation has been coming down from the historic highs to a 6.5%, 7% level, you're seeing that in the left-hand side, the graph, the red part is the financial household savings, and the gray part is the financial physical household savings. So 2014, 55% of a person's money was in physical assets, gold and real estate, the like, and only 45% in financial assets. By 2021, the ratio has reversed. Today, 40% only of the household financial assets are in physical, but 60% are in financial. Why is this? Because when inflation goes up, the red line, you will see the dark line, physical savings goes up. When inflation comes down, physical savings comes down. What is the reason for this? Because when inflation goes up, people feel natural protection in gold and real estate. But as inflation moderates, they realize the value of financial savings and the share goes up. So that's where we think this will grow. And at this point in time, if you look at the right-hand side last graph and look at the bottom, and you will see that 2% only is of the household financial assets, only 2% is the share of mutual funds. So the share of mutual funds has been growing. It has grown at 23% CAGR over the last 4 years, but still it's only 2% of the share. So this rapid growth rate means that India's financial assets, first of all, as a percentage of total financial assets in the country, India is way, way below at the right-hand extreme compared to the rest of the world. And countries like Turkey and Greece are at 60 to 70%. So India has a long way to go in terms of increase of household financial assets, which will happen as our per capita income goes up. Second, within the financial assets, if you look at the mutual fund, already I showed you that it's only 2%. But if you take MF assets as a percentage of GDP, India with 12% is among the lowest among the big countries of the world. US is at 120%. And within the overall MF assets, only 5% is equity assets. So obviously, as the household financial assets pool goes up, as inflation remains moderate, you will see the share of financial assets grow, and within that, you will see that the share of mutual funds also grow. Hence, the time is ripe for the MF industry to increase its penetration massively and provide massive support to the stock market. So on the long-term FIIs and mutual fund, both are geared to provide buying support to the stock market in the coming decade. So from that point of view, if you look at the medium-term outlook of our equity markets across China, Korea, and India examples, the medium-term growth of the stock market tracks the medium-term growth of the nominal GDP. So that point of view, if you now look at it, right, in India, over the history, broadly, the stock market nominal GDP stock market growth has directionally tracked the nominal GDP growth. And from that point of view, if you then take a look at the growth in various time buckets, over a 5-year period, perhaps stock market sometimes gives you negative 3%, sometimes 41% positive, like that. But if you take a 10-year CAGR, at one 10-year period over the last, from 1995 to now, it gave 20% return, and the previous 10-year period is given a 12% return, which is roughly in line with the long-term nominal GDP growth. So from that point of view, right, the next question that arises is between mid-cap, large cap, and small cap, because those returns that I showed you were large cap returns. How does you do allocation? From that point of view, please understand that Indian economy has been through various cycles. So 2003 to 8 was a virtuous or a good cycle. 2008 to 13 was a bad cycle. Again, 2014 to 17 was a good cycle because Modi government came to power, a lot of development took place. Then again from 2017 and December 2017 to March 2020, we were in a downtrend cycle. Again, now from March 2020, we are on a good virtuous upcycle with a V-shaped recovery, right? So when you then split this period into the bad period on the top and the good period at the bottom, in the bad period, yes, market gives you negative return, but the negative return you get from mid and small caps is much larger than that from large caps. Whereas when the economy is doing well in a virtuous cycle, you get positive returns from all segments, but your small caps and mid caps do much better than the large caps. So given that I've painted a good story for India over the next decade, you can expect mid and small cap returns to be better than large cap returns. Hence, if you see, how do you make money then from the market? You make money not only from the better EPS growth. If you take the last two tables here, the first is the change in the index, large cap, mid cap, small cap, with respect to the previous high in December 17. What are you seeing there? The index has gone to 74, and you're seeing that the EPS has expanded by 42, but mid and small cap has expanded by 50% plus. So when from previous peak to this peak, you're saying already mid and small caps have performed better in EPS. At the same time, the valuation of large cap has expanded because FIs have pumped in a lot of money, but mid and small cap valuations are still at about the levels of the previous peak that we saw in December 17. Now, when you compare to the previous low, which is the COVID time low, take the next table on the right-hand side. The index performance is given there. But if you see the EPS growth, right, this time in the bounce back, the EPS growth has been roughly 54, 50, 63. But the PE expansion from the bottom has been far high for mid cap and small cap. So you can see that you make money from both EPS expansion at times and from valuation expansion at times. And hence, if you see, going to the table down below, you'll see that in December, when the market was at its peak, mid cap index was trading at 35% premium to large cap and small cap at 12%. Today, they are nowhere near that premium. In fact, mid cap is only at a 8% premium to large cap, and small cap is at a 8% discount. So clearly, as the economic growth story plays out and both the EPS expansion happens and then the valuation expansion will follow, you will expect that mid and small caps will tend to give you a better return during a virtuous cycle. And this investment plus consumption story, which is going to fire India's growth, is essentially a mid and small cap stock story. So from that point of view, over the medium to long term, a domestic oriented, broader cap curve oriented. Why domestic oriented? Because the world is going through a slowdown. So export sector will have under pressure. Broader cap curve. Why? Because you have to have a blend of mid and small cap. Why? Because while large caps will get support from FIIs, you will get mid and small cap support from domestic mutual funds, also from the EPS growth during the good economic cycle. And hence, overall, such a thing over the medium term is expected to deliver to you a double-digit return in line with the double-digit nominal growth that India has experienced to experiment. So from that point of view, right, where should you put your money? If you look at it, you should put it across flexi cap and multi-cap kind of funds, which give you a blend of large cap, mid cap, and small cap. So on that note, let me conclude by thanking you for your patience.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.